G'day traders. Righto, so tonight what I wanted to have a look at and focus on is money management or risk models, and I feel this is probably something that's really underutilized in the trading industry. Okay, just to set it up, what do you got here? You can see a bit of a pie chart. Okay, I got three areas here, what I call the three pillars of trading strategy. Okay, this is certainly not something that's any new. It's quite out there. Traders will call it all sorts of different things, but basically we got mindset, or your thinking. We got the money management or the risk model, and then we've got the system development part of it, or your actual methodology. Okay, there's percentages attached to those. At the end of the day, all three are very important. You need all three to be very carefully calculated, and developing all three to move ahead, that's for sure. But I guess there becomes a bit more of an emphasis on each of these three areas. Like mindset tends to be the biggest thing there. There's a lot of information about this. As at the end of the day, without the right thinking, it's going to be very hard to move ahead. Then next comes risk models, and again, this is why I think this is underutilized, because you hear a lot about, of course, mindset, but then it's all about, seems to be about systems and system development. But what I want to do is, I guess, kind of maybe, hopefully set off a few light bulbs for you guys tonight, and there may be even more sort of questions raised than answers, but set you on a bit of a path to find out more information about this and start to understand that risk models are massive, and you can almost start to place a lot more emphasis on this than the actual system. And when I started to get into this, it all of a sudden really changed my perspective of trading, and certainly started to discover a lot of things. As traders, we've all been around for quite a while now, months or even years. I think if you really want to start moving ahead, this is the next thing to start looking at. I know I've been spending probably the last 6 months on really starting to develop this, and it's really changed the way I approach the markets, and it's a big part of trading, and hopefully you really get something out of this, because it's certainly changed a few of the ways I've looked at some things, especially just over the last few months. It really opened my eyes to a few things, and like I said, there's a lot of information out there about this, so really get out there and get amongst it and see what you can find. I'm going to do this bit of a talk over two parts. Tonight I just want to focus on the risk model, and then the second part we're going to talk more about capital risk per trade, so the individual, what you should be risking per trade, and do that over two sessions, so that next session will be done in a couple of weeks. Righto, so let's get into it. Risk models. Okay, so the first thing I want to say, just leading up to this, just to kind of set it all up, is when you look at risk models, okay, it's all about sort of the downside of things, or the potential losing side of things, okay, which might appear to be a little bit negative, but I certainly see it in the opposite direction and go, well, when you come into trading, it's kind of like, as a new trader, and sometimes in this industry out there, it's kind of perceived that you don't want to have anything to do with losers. You want to avoid losers wherever possible, and losers is a bit of a voodoo situation. At the end of the day, when you look at the professionals and the guys that really make it, they're out there and they're making losers and establishing that losers are an absolute part of this industry and part of the business. And it's almost like, there's the common example, like a restaurant, your costs are food and electricity and all those sort of things. You want to see losers as just a part of the cost of the system, your business costs. Okay, so when we're talking about creating profit from a system, you're never ever going to attain profit without some sort of drawdown. Okay, it's up to you how much of a drawdown you want to have, but you're never going to get there without some sort of drawdown. So with that in mind, why worry about the losers? Okay, you're never going to make it if you hate losers. If you get this sort of sick feeling in your stomach every time you have a loser, it's okay to be in that situation. We've got to start to understand that we need to start embracing the losers and creating a situation where we put the losers up there front and center. But what's important is we establish boundaries or perimeters around these losers and really understand it that way. If you hate losers, or if losers is something that you really despise, what I'd say that comes down to, and I know this is something that I've really had to develop for myself, is if you hate losers, is what you do is you don't really understand system development, and there's a lack of a risk model around this part of your trading area. Okay, and I'll elaborate on that in a sec, but what it's all about is taking these losing trades and making it okay by creating these risk models around it, and saying, okay, well, let's embrace them, let's create some figures around it, and start to establish, okay, that I've got X% chance of having losing trade. I've done all these calculations, I've back tested, I've got X% chance of having losing trade, and even taking it further by saying, okay, I've got X% chance of having this many consecutive losing trades in a row, and really establishing what our potential worst case scenario and things like that could be. And then we start to create this information, this intellectual information. This is what becomes power. This is absolute power, and this is when you'll start to realize that It's all about risk models, and this is so much more, or it's right up there, and what I see is more important than the actual system. Okay, when you're armed with this information, it's much easier to deal with the losses. Okay, the only time losses becomes a problem, you imagine we've created these risk models, which I'm about to elaborate on soon, so we know exactly where we stand, but all of a sudden we start performing outside of those perimeters. That's when losers becomes a problem, and maybe we've got to step back and have a look. But as long as you're within those perimeters that we've back tested over a decent length of time, then losers, or even many losers in a row, it's not an issue, okay, because we've established where we stand in regards to that. So what it has to do is it all become the one thing. Okay, winners or losers, it doesn't really matter. Okay, we can establish for ourselves what we stand to make every time we take a trade. So by implementing some of these models, which I'm about to show you. So, and the other little point I wanted to make is, you're never going to get profit from your system either over long term if it's all about you. Okay, don't see your trading system as you. What it is, it's all about your method and your risk model. Okay, you're there to execute it, but the goal should be to see this, the making money situation as it's all about your model and not you. Okay, you need to take you and the ego, as far as what sort of winning percentage can we get, and average size of winners and things like that. That's all ego and that's all emotional attachment. So we need to take the emphasis off that and place it all on the system. Okay, at the end of the day, each individual day, like trading the zone talks all about this. We can't really change what's going to happen as far as winners or losers. We might have 3 winners, might have 3 losses. It doesn't matter, because at the end of the day we can create an amazing system, amazing risk model, and then over time we can really establish these percentages or these perimeters, and then we know where we stand. Okay, so the strategy should be to separate yourself and the ego that's attached with that from your model, and what you want to do is create something that you manage. Okay, so that at the end of the day, the question is, do you see your trading system as your model and everything involved, or do you see it as you? That's something when I really started thinking about and kind of change a few ways I approach things. I really set out to create something every day that it's all about the model, and it's a very precise model. I'm just there kind of managing it, and it's just not about me taking the individual trades. It's a lot better place to come from. It's a lot better way to be able to handle the losers. Okay, so let's get into it. Let's bring up a few sheets here and talk about a few things. So I want to talk about money management, and then kind of define the perimeters of risk model, and then we'll break these areas down a little bit further, and hopefully be done in about 30 minutes. So I don't want to make it too long, but make it more impactful. Okay, so money management, 3 things that's all about. So the initial capital at risk at the initiation of every individual trade. So what this is, when you look at trading, what I tend to find happens out there is, it's sort of, when we start trading, we're just slapped on us with this figure that we just need to risk 1%, 2%, 0.5% of our capital, or something along those lines. We haven't taken the time to work out exactly, based on our situation, our capital, our personality, what we're trying to achieve, is what we need to risk. Okay, it's almost just like it's sort of like a fixed amount out there that you just need to do this. But at the end of the day, who knows? Like, each individual is different. So what we need to do based on money management is calculate exactly what we need to risk. And this is going to be a lot more part of the second part of this talk in a couple of weeks, but we'll certainly touch on it tonight. And then when we know individual risk, we then take that a bit further and understand consecutive loss potential. So this, all of a sudden, we really start putting it out there and go, okay, well, based on my system and my model, I know that I've got this X percentage chance of having this many losers in a row, and kind of establishing what our sort of maximum drawdown is going to be. And if we create some perimeters and boundaries around this, when we do start having losing streaks, of course, anyone can handle the winners, but when we get into a bit of situation where we're losing, you can imagine on big contracts, you have a few losers in a row, what needs to happen is you have a risk model that's already established these sort of boundaries and what kind of happens based on your past performances or based on back testing, and you can understand that you've had losses before, and you understand that in regards to your system. So consecutive losses in a row doesn't phase you much, so we want to work that out. Okay, and then finally, risk to reward ratio. So what do you stand to make every time you go in and risk your capital per trade? Okay, and this kind of can really fluctuate. At the end of the day, there's some people that and there tends to be the common thing of a 50% strike rate, which is fine. Some people, there's no reason why you can't have a system that strikes at 30%. Okay, there's many great systems that make a ton of money based on 30% strike rate, or a ton of money based on 70% strike rate. Obviously, they're completely different ways of trading the market, but it really doesn't matter as long as you know, and it's based on expectancy and frequency, which I'm going to start getting into and explaining a few definitions in regards to that. But based on that, understanding what do you risk to what do you potentially gain, as long as the model is mathematically sound and it's set up so it can make you profitable, you're not setting yourself up for failure, so you're setting yourself up for success, then you're going to be fine. So this is all about risk to reward, and I'll get into that very soon. And I guess back here just for a second, the common theory, start off with, it's all money management, just about cutting your losses and letting your winners run. That's great theory to start off with, but like everything I'm going to talk about tonight, it needs to be a lot more precise, a lot more defined than that, and we need to get into a lot more detail. Okay, so let's talk about risk models. Some of the variable parts of a risk model. So the first thing there, winning and losing percentages of your method. I think this is something that most traders tend to understand a little bit about. But do you know exactly where you stand as far as what kind of strike rate your system has? Again, it doesn't really matter what that particular strike rate is, but you need to understand it and have some really detailed recording systems, and then also some really good backtesting systems as far as understanding this exact figure of what when you go into the market, where do you stand as far as your chance of having a winning trade and losing trade, and as far as understanding as to we have the potential to really impact this kind of percentage, and I'll elaborate on this in a second. Frequency of trade signals. So again, this is probably something people have thought about. You might have a rough figure, but what is important is this is an absolute just as important part as your winning and losing percentage. Okay, and you'll see why in a second, and I'll take you through a few things in regard to frequency and how it can completely change your risk model. Okay, the next part here, this next two, is all about expectancy. This comes under the definition of expectancy. I'll explain expectancy in a second, but expectancy is kind of the other side of your winning and losing percentages. Okay, so expectancy is the average amount of money that you make on your winning trades and the average amount of money you lose on your losing trades, and expressing them as R multiples. So I'm not sure if you guys have heard of R multiples before, but I'll expand on this in a second, and you'll see why it's important to express it in mathematical terms, so that way when you do grow and expand, it's all been established, and you've got this room to be able to move, but it all stays the same as far as your risk model is concerned. And then max drawdown potential. This is something that really quite excited me when I started to look at it. Something I certainly never thought about for a while, and I think a lot of traders don't look at this, but I'm going to touch on this at the end, and this is quite exciting, this part, but actually it's sort of almost the missing link to trading, and you'll see why in a second. But finally, the point I wanted to make in just regard to this is, and I'm starting to touch on it back here, is that it's important to understand that you have significant control over each of these variables. I'll bring up a bit of a table soon explaining this, but you can be in a situation where you have a really high winning percentage of trades, but your average win per trade is going to be a lot smaller. You imagine you're going for these quick short profit targets, but you lose it. So you might have a profit target half the size of your losing target. Not something I'd personally do, but you can do that. Or you might have a losing percentage that is lower, like 50% or even lower than that again. But your average winners are a lot bigger than your average losing trades, and that's kind of the way I like to function. But I'll bring up a table, and we'll certainly elaborate on that in a second. Alright, so as a trader, I understand you have the power to establish your chances of having a winning or losing trade by the decision of where you put your profit target and your loss target. So this is in regards to modifying risk variables. So this is why exit is everything about trading, and when we're talking about risk models, it's all about the exit and what we do per individual trade. So systems are all about the entries and where can we get an entry. Risk models are more about some of these variables as far as where do we get out in regards to that. So because based on your trading profile of each trade you take, so how you establish yourself in regards to each trade, ultimately the profitability of a trader all depends on how much the trader wins when he has a winning trade, and how much the losers are when he has a losing trade. Okay, so it's the average winning trade, take away the average, taken from the average loss per trade ratio. That means absolutely everything in trading, absolutely everything in trading. Okay, when we talk about modifying risk variables, so I touched on before, you can imagine, why you have the ability to be able to modify this is because if you imagine you got a kind of a table here of profit and losses. Okay, so you go for a small profit, and then you've got a loss or a stop loss set that's a lot further out. You might have an inverted 2-to-1 ratio. You risk 10 ticks to make 5 ticks. Okay, you have a very high percentage of getting a winning trade. I mean, you could just guess, and chances are you're going to get a winning trade. But your average winners are going to be a lot smaller than, say, someone that has a situation where they go for profit targets, 3 times or 2 times as big as they're losing as their stop loss. So that particular case, your strike rate of winning trades decreases, but your average winning trade increases. So based on that, and there's everything in between, of course. So based on that, you have the absolute power to be able to modify these risk variables. And it's all about you as an individual trader, and the pros and cons of each of that. So with higher winning percentages comes smaller winning amounts. With higher winning amounts comes smaller winning percentages, and vice versa. And like I said, everything that's in between. So when you look at it based on a risk spectrum, so think of a line here. We've got the scale from the very left end. So let's say down this end is number 1, up this end is number 10. So where do you sit as far as a trader between 1 to 10? Okay, so if you're at the far left end of the risk spectrum, not that any end is right or anything, but what happens is down here, let's say this is the end of lower strike rates, so less winning trades, but with less winning trades comes higher profit or higher winning individual trades, because you're going for bigger profit targets, but you're getting it right less of the time. So you've got lower probability of getting it right, but your expectancy starts to increase. And what expectancy is the average winnings that you make per trade. Okay, and I'll really elaborate on that in a second. But down this end is the low probability, high expectancy. So if you think of following trends or swing traders, longer term traders, where they tend to look for trends and breakouts, things like that, they quite often take a lot of trades, but every trade they're risking a small amount. But when they get their winning trades, they tend to be big winners. Okay, then right up the other end of the scale is your high frequency scalpers and things like that. So you might have a system that's got a high probability of winning. So short profit targets but bigger losses. So you got really good high chance of getting winning trade, but then your expectancy, so your average amount that you're winning per trade, starts to really decrease, of course, on the spectrum. So you can see there's a balance, and where are you? Okay, where do you sit? Do you want to be up here with lots of winners but less winners, less amount that you're winning, or in the middle, or somewhere to the left? Myself, I find myself, I tend to sit towards the middle, maybe starting to get towards the left hand side of things. I really want to create a situation, this is up to the individual, where I don't mind having a few losers, but I just want to have slightly bigger trades. But I'm certainly not right down the left hand end of that. I'd say I'm right smack bang in the middle. I've got a 2-to-1 ratio of winners, of profit to loss, and expect a 50-60+ % strike rate sort of thing. But that's something that you can work out as an individual trader. So it's important to find out where you sit on that spectrum. The common perception is that we're kind of sat in this box and we're taught one way on how to do it, but that's certainly not the case. Even within our trading room, you have the power to really change and decide where you want to be in regards to this. It's something that you need to figure out. It could take months. It's not something that's going to figure out overnight. But whatever you do decide on, at the end of the day, you want to see yourself as a professional trader and establish these risk parameters. And even if you're just trading for yourself, treat it like you're a fund manager or something like that. Approach it like the big guys do, and what they do is they really start to focus on. Hopefully, we'll start to see this. That's all about the risk model, not so much the actual system. And you'll start to see what I mean by that. All right, so let's get into a little bit more about as far as what this spectrum means to us as individuals. So probability, everyone kind of would understand that straight up, that your strike rate of your of your trading method, it's quite easy to understand. What sort of, out of every trade you take, every 10 trades, how many do you get right and how many do you get wrong? Again, it doesn't matter if you're on that scale. If you got 3, 4, 5, 6, doesn't matter. What does matter, but your expectancy in relation to that. I should say, not again, expectancy doesn't matter, but in relation to each other, it matters. Okay, so let's get a bit into expectancy. This is where it starts to get a little bit heavy. So hopefully I'll do my best job explaining this to you guys. Again, it might raise more questions than answers, but I want to send you on a get you thinking about a few things and get the journey started. Because I know once this little bit of a light bulb was set off for me, off I went and I found all this information on it, and it really made a difference to me as a trader. So expectancy is a mathematical formula that conveys how well a system will perform over a long term and how much it will make. Okay, with everything involved. So what it is, it's the average amount of money that you will make in your system over many trades per dollar risked. Okay, so what we're going to talk about is R values. Okay, R multiples. So your initial risk is what we call R multiples. Okay, so it doesn't matter how much you risk, whether you're risking 1%, 2%, or 3% of your account, it doesn't matter. Okay, so for all these examples, what I want to talk about is keep everything kind of easy to calculate is 1% risk. Okay, so let's say we're risking 1% every time we take a trade. So if we're risking 1% every time we take a trade, our initial risk is 1R. Okay, meaning 1R is 1% risk. Okay, so let's say, for example, we've got a stop loss set of 5 ticks. We're risking 1% of our equity. If we close that trade out for a complete loss, we've lost 1R on our account. Okay, we're going to start expressing things in R values, and it's an easy way to move ahead when we start doing that. If we look for a profit target of 1%, so let's say we risk 5 ticks to make 5 ticks, and we close it out for a 5 tick profit, we've just made 1R on that trade. Okay, if you're risking 1% again and you go for 10 ticks, and when you're risking that 5 ticks, okay, so obviously you're making 2%. When you're risking 1% of your capital, you've just closed out a 2R trade. Okay, it's these R multiples that are a major element of trading success. So it's the average amount of money that you'll make in your system over many trades per dollar risk. And what I'd say is, do you know the expectancy of your system, the R value of, if this is something new, obviously you've got to go out and work it out, but take the time to work out the R value of your trade, and I'll explain what I mean by that. So expectancy, if we would place a formula on it, and I'll bring up an example in a second, and hopefully that will start to explain a few things. But what we're going to look at is the average R value, so the average R of your wins. Okay, so rather than looking at it going, okay, my average winning trade is this many ticks, it's essentially the same thing, but expressed in R value. Okay, so we want to take the winning percentage times by the average amount of our winners, average win, expressed as an R value, take away the losing percentage of our system, multiplied by the average of our losses, or the average R losses. Okay, and that's going to give us an expectancy rating. So let me bring up something here. Okay, so let's run through an example of this. For the month of June, based on risk, where our maximum risk is 1% per trade, and our stop loss is 5 ticks. Okay, so for the month, this is what we did. We took 9 trades. We had 5 tick loss, 10 tick winner, 12 tick, 2 tick loss, 3 tick loser, 1 tick break even, 10 ticks, lost 4 ticks, 1 10 ticks. Okay, that's in tick value. No, we can do it like that, but if you want to take a step forward, and you'll start to see why this is valuable, is you express it in R multiples. Okay, so again, 5 ticks is our maximum stop loss, so it doesn't really matter on the percent of the account that we're risking, but if we take a full stop out, that's 1R. That's a 1R loss. Okay, in this particular case, it's 1% of our account. If we're risking 2% of our account, a full loss or a 1R loss is 2%. Okay, then if we look to make 10 ticks, so we've gained twice as much as we're risking, we've made a 2R on that trade. Okay, so all of a sudden, when I write out my sheet at the end of the night, I'm not writing out what I'm making, I'm writing it out in R multiples. Okay, so then all of a sudden here, this trade here, we made more than 2 times what we're paid to risk, so we got a 2.4R trade. Here we reduced the risk a bit, so it wasn't a full stop out, we got a 0.4 of an R trade. and you can then go ahead and work them all out based on your initial risk. Now, with that in mind, back to this formula over here, we've got to work out a few other things. So we need a few percentages. So back over this example here, so 9 trades, we had 5 winners, so 5 divided by 9, our strike rate's 55%. 4 losers, 9 trades, our strike rate's 45%. So what you'll start to find here, and just kind of just a sidetrack for a second, is obviously I'm working out things here, just an example based on 1 month. Obviously it's not going to really work based on a short time frame. What you want to do is get this sort of information. Where this becomes really powerful, and you'll see why, is if you start finding this information based on your system over months and months, or even years, or not so much that, maybe over multiple hundreds of trades. So if you've got a system that's producing, say, 10-20 trades a month, if you go back over and work out the last 200 trades, these sort of figures, this is where this information starts to become really powerful, and you'll see why. Okay, so side note is systems, and when I started working at this thing, this is when I started to realize that I have to be a little bit more systematic. Okay, at the end of the day, your system can be automatic, it can be a bit discretional, but you need to be very systematic as the way you approach the market. So that way you can go back through the market or forward through the market, forward testing as the days go by, and work out exactly where you stand and go, okay, I can go back a year ago and look at particular days and work out what would happen with my system. There's data, or there's software that you can use to back test, and you have to probably manually go through it. That's what I do. You can't always get something that's going to punch in some numbers and spits out these figures out for you. You have to manually go through all the charts. It could take weeks, could take months, but something you need to do and create these figures. And what it does is, like I said at the beginning, it arms you with some powerful information, and all of a sudden it really sets your mindset alight. Okay, so with that in mind, obviously this is better. The longer time frame it's created over or calculate over, the better. Okay, but for this example, we're just doing it over 1 month. Okay, so this is our strike rate as far as what we're concerned. Now what we're going to work out is the R multiple of winning trades and the R multiple of losing trades. Then we're going to work out the overall R multiple of our system, which is expectancy. Okay, so the R multiple of winning trades, so mean R of wins, is just what we do is add up all the R value of all the winning trades and divide it by that number of trades. So we had 5 winning trades, so 2 plus 2.4 plus 0.2 plus 2 plus 2, that adds up to 8.6 divided by 5. Our mean R value of winners is 1.72. Add up all the losers, divide it by the 4 losing trades. Our mean R value of our losing trades is 0.7. So what this means is, all of a sudden, if we'll just add it up and tick values and work out that we've got, I don't know what that is, 30 ticks in winners, that doesn't mean too much, but all of a sudden if we express in an R value 1.72, that means for whatever we risk, and again that risk could be anything, in this particular example we'll say 1%, so for our risk that we take for each trade, we're risking 1%, 5 ticks in every trade we take, our winners, you've worked this over a long time frame, our winners stand to make 1.72 times what we're prepared to risk. Okay, so if we're risking 1%, every winning you take, on average, you're making 1.72% on your account. Same with losers. Every time you take a losing trade, based on averages, you actually stand to risk 0.7% of your account. Okay, so then if we take those numbers, punch them in this formula over here, 55% times by our average winner, 1.72, minus 45% is our losing percentage strike rate, times by 0.7%, which is our R value of losing trades, and that equals 0.631, or in brackets there you got 0.6 of an R. So what does that mean? That means every time we take a trade, winner or loser, we stand to make 0.6 of what we risk. So if we're losing it, again using the example of 1%, so we risk 1% of our account, every time we take a trade, doesn't matter whether it's a winner or a loser, we know that we're going to make 0.6%. So obviously individual trades is different, so this is why we've got to start looking at things over a longer term, and again it comes back to every individual day we can't establish what we're going to make or lose, but over a long time frame, like they talk about trading in the zone, absolutely we can determine that sort of figure for ourselves. Okay, so individually each trade over a long period of time, based on this formula here and these figures, we know that winner or loser, it doesn't matter, we make 0.6 of what we risk. Okay, so as long as that R value is somewhere in the positives, obviously you're going to start making money. And the R value doesn't necessarily have to be high or low. It depends on a few other things which we'll start to get into. But for every trade we take, we're making 0.6 of what we risk. So if we risk 2% of account, we're going to make 1.2% every time we take a trade. Okay, and you start thinking in mathematical formulas like this, and it's based on a really strong risk model, and you've done a lot of back testing, then the winners. That's why the winners and losers start not to affect you as much, because you just know it's all part of the. That's why losers is just part of the system. It doesn't matter if it's a winner or a loser. Every trade I take, over the long run, I know I'm going to start increasing my account by 0.6 of my risk. Okay, so now it's down here. This is how much you can make per trade on average. Of course, on average, so it's not every individual trade, but on average over many trades. Okay, so does that start to make sense up here? This is what I mean by expectancy. Okay, you have a high strike rate, your expectancy is a little bit lower. But that doesn't matter, you might be taking a whole lot more trades. And I'll show an example of a number of trades taken in a sec. But then you have something that's a low probability, but you've got a really high expectancy. And if you've got an R value now say, let's say have an R value of 2 or 3, every trade you take over a long term, on average, you stand to make 3 times what you risk. Winner or loser, you make 3 times what you risk. So then all of a sudden you've got a high expectancy. You don't need a high probability of trades, because even though you're getting loser, winner, you've got high expectancy on your trades. Okay, so then obviously the next step, something that's really missing from this, is determining the frequency. So the next step is how many trades your system will yield on an average per day, week, month, year. Okay, so this is why it's important to kind of not just have a rough figure here, but have quite a calculated and fairly close figure to something that's quite precise. Okay, so back up here, and let's take our average figure we've worked out over 1 year of data is that we're taking 9 trades on average per month. Okay, so we take this 0.6 R times it by 9, and that gives us 5.4 R. So our value, or the value of our system, is 5.4 R. 5.4 R times by 1% risk, so that means we're making 5.4% of our account every month. If you risk 2%, 5.4 times 2, that's 10.8% per month. But it's the R value that matters. Okay, so 0.6 times by 9 trades a month gives us 5.4 R on our system. Okay, so an example here, what's better? Is a 1.5 R better or a 0.6 R better? Well, at the end of the day, we don't know. It really comes back to your frequency. So the complete formula is adding frequency. And so let's say, for example, you've got something, a 1.5 R is obviously something where you're looking for bigger profit targets and smaller losses. So you're making a lot more per trade on average. But it might be something that you're looking really detailedly into the markets, and it's only producing about 3 trades a month. Well, what this actually means is that this particular system, 1.5 R, remember we've calculated it based on winners and losers and strike rates. So every trade we take, winner or loser, we stand to make 1.5 times our risk. So 1.5 times by 3 trades, we stand to yield 4.5%. Month, year, whatever you're working it out over. Take that same one, that 0.6 R, so expectancy a lot less, but maybe it's a bit more of a scalping technique or something like that, but you're still doing quite well with it, and it's producing 20 trades a month. Well, then you take those 20 trades times by 0.6 R, and all of a sudden you start yielding 12 R. So I shouldn't say percent, it's 12 R there, which in our case we're basing on 1% is obviously 12%. Okay, so expectancy, or your R value, it doesn't necessarily have to be high, and that's why this, we start talking about this risk spectrum. It doesn't really matter what your expectancy is, but when you tie it all in together, probability, expectancy, and frequency, that's what really matters over the long term. You've got to establish exactly where you sit as a trader in regards to that. So obviously your complete system returns every year, it equals your expectancy multiplied by your frequency. It's completely up to you how what these figures, how you determine these figures, and you can increase them and decrease them based on your system. And again, I've got another example of there something, it's a smaller expectancy but a lot more trades. You're looking at an R value of 4R. I should put that in there. Here you got an R value of 2.7R, so 0.9R times by 3 trades, 0.7. So this is what you're returning is based on 1%. That's pretty easy to work out. It's 2.7% return or a 4% return. Okay, so hopefully that starts to make some sense, and you can start creating this risk model. So that's just one part of it. But before we get into the sort of the drawdown side of it and what you potentially should be risking in an individual trade, back to sort of the top again and what it's all about, this risk model. Okay, so winning and losing percentages of your method. So again, now you can start to understand that you can alter this winning and losing percentage if you want, and it doesn't matter where this percentage lies as long as you've got all these other values worked out and they're all working in your favor. Frequency of your trade signal, this is just as important as your winning percentage. You need, if you have something with a really high strike rate but not many trades, well, you need to look at both sides of the equation, is what I'm trying to say. Okay, expectancy. So what's your average winning trade, and what's the average amount you win per winning trade expressed as R, and what's your average loss every losing trade expressed as R. And then you want to work out maximum drawdown potential. So this is what we're going to start looking into now. So let me bring up this. Okay, so max drawdown. So after testing, so this gets a bit more into back testing. So let's say you've got a system, you've got a method now. After testing, so going back through the markets, let's say you've got a system. You want to go back over the last 100 trades. Okay, so you go back over the last 100 trades. After testing, you discover that your maximum loss or losing streak is 6 trades in a row, or expressed as R, 6R, because we risk 1R. Doesn't matter what you risk, but a full loss is 1R. Okay, so your maximum losing streak is 6R. Now we always work in trading as far as is worst case scenarios. Okay, so rule of thumb is take your maximum amount of losses, 6 losses in a row, times it by 2 or 1.5. I myself, I've times mine by 2 to work out your worst case scenario. So in case the worst is still to come, it might never come, but so be it. Hopefully that's the case, but we want to be prepared for the worst case scenario. Okay, it's very important with trading. So you take a 6 trade losing streak. So let's say, for example, I've taken worked out over the last 100 trades that 6 trades is my worst streak. I times that by 2. Now I've got a situation where I can my worst drawdown on my account is 12R, or 12 times what I'm prepared to risk. Okay, so let's do a bit of an example of this, and this is kind of getting into what I'm going to start talking about next week, or sorry, in the next 2 weeks time. But when we start looking at what we should be risking per trade based on our how we're approaching this market. But if you say, for example, let's take an example of 20%. Your maximum drawdown is 20%. So from top to bottom throughout the years, you never want to be down more than 20% on your account. Okay, so let's take 20%. And you divide that by 12R. Okay, so that's your worst losing streak is 6 trades times by 2, so 20 divided by 12. So meaning that comes to 20 divided by 12 is 1.6. So you got the situation where so 1.6 should be your maximum risk per trade, and that's 1.6% equals 1R in this situation. Okay, so you worked out that you should be in a situation where you never get more than 12 trade losers in a row. So if you're risking 1.6%, you should never get in a situation where you're more than 20% down. Okay, so let's say you're in a bit of a streak. This is where the information becomes powerful yourself. You've got 4 losing trades. You know that your risk model is based on having 12 losers in a row. You've worked that out. That 6 is your worst so far. You're working from a worst case scenario, so you've doubled it, made it 12. So you've got 4 losers. You're well inside those risk parameters, so there's no issue and for that reason, you're nowhere near your maximum drawdown potential. You understand all your R variables, and it's just all part of the system. And so there's no problem. Keep on clicking that button and taking another trade, even if you had like 3, 4, 5 losers in a row, based on this situation. So this I really want to elaborate on in a couple of weeks, but hopefully that's just a little bit of a starter. And when I started looking at this, I just thought, wow, this is powerful information. And all of a sudden, when you start looking at this sort of thing, you start to realise why it's so important to understand a risk model. And yes, systems are important, where you get into a trade, but I think it's a lot more important to establish the perimeters around those trades, which is your risk model. So the moral of the story is you need to have a plan to manage your drawdown. Okay, so you understand your maximum losing streak as long as you're within this range. So I just want to bring up a table here to explain this a bit more. So as long as you're within that losing streak range, there should be no problem, and you should feel comfortable. Okay, and just to elaborate on that idea, down the left-hand side here in this yellow column, we've got your percentage of winning trades. Okay, so let's say your system strikes at 70%. Okay, you got a system that produces 70% winners. So something like that. Obviously, your average winning losses might be a bit smaller than say something that's winning 30% of the time. But so 70% winning trades, or 70% chance of having a winning trade. Obviously, to have a loser, so it's the 30% chance you can have a loser. Okay, and then based on that, if you work it out, that you've got a 9% chance of having 2 losers in a row, 3 losers in a row, 2.7, 4 losers in a row, 0.8. And on you go. So based on this sort of model here, you wouldn't expect to have big losing streaks that often. Okay, otherwise something could be going wrong if you're getting up around anything more than 4%, because all of a sudden those percentages, when you work out percentages, if you've got a less than 1% chance of having 4 losing trades in a row, yet you're all of a sudden you're going through a situation where you're having 4 losing trades in a row quite often, something's going wrong. Okay, but you also know these figures, and these figures are kind of a bit of power to you as well, so you know where you stand. But something like, let's go to the other end of the situation, a 30% winning trade. Chance of having a winning trade is 30%, but your R value might be quite high, 2, 3. So you got these big. When you do get a winner, you get big winners. But when you have a loser, which is more often than not, they're small. They're really restricted. Okay, so you got a 70% chance of having a losing trade. There's still a 50% chance of having 2 losers in a row, 3 losers, 4 losers. 4 losers in a row was still up around a quarter of the time, 24% chance, because you're having small losers and big winners. Okay, so if you say in this kind of situation you're taking, let's say, 2 trades a day on average, 10 trades a week, 40 trades a month. With this in mind, and this is why it's powerful to kind of understand this information, with this in mind, you're taking 40 trades a month, and if you're based on this system and you know that it's 24% chance of taking 4 losers, well then you know that if you're taking 40 trades a month, for example, there's a chance you're going to have, probably every month almost, a streak of 4 losers, and it's all contained within that risk model. And so you're sitting okay with that sort of information. You know and understand that. But of course, depending on where you lie on this percentage win scale as to how comfortable you feel with the number of losers in a row. And again, the moral is to really define everything, and then as long as you're operating in those perimeters, should be happy days, and there shouldn't be a problem. Alrighty, so hopefully that makes sense. So just to finish off, what I wanted to say is, with this in mind, risk models in mind, there's 2 things that is what I got, which when I sat down and thought about, again, it's powerful information. There's 2 things that will cause failure for a trader, and they're kind of twofold. They double up on each other. The first thing that creates failure is a failure to build a risk model. Okay, so your risk model is the absolute linchpin of success. Hopefully you're seeing that now. Hopefully you're seeing why this is so important, and it's right up there and probably more important than your system development. Okay, so the first thing with failure is failure to build risk model. Okay, the second part of it is a lack of discipline to execute it properly. Okay, so your ability to execute the model is what makes you successful. So, first thing is you need to have something, you need to consider and do this and go ahead and do it. You haven't got anything like this in place, well, definitely, alarm bells should be going off, going, oh, I need to get onto this straight away, and really take the next however many months to define and really make something solid in regards to this. And then that's a great little stepping stone for creating success right there and then. And then the second thing is to be implementing it and having the discipline to execute it properly. Okay, so just to finish off as to why this is so important in regards to system development, if you're a new trader, I think all of us in here could consider ourselves new traders, anything from 1 to 3 years experience. And if you're jumping around from system to system, I know it's something I used to do. I used to, if I would just couldn't get any sort of momentum going, and I go, okay, I need another system, and I'd jump around a little bit. I think everyone can relate to this. And it wasn't until about 18 months ago that I really decided just to focus on something and just develop a system. And then just more recently, in like the last 6 months or less, really started to go, okay, yeah, I've been focusing on the system, developing it, but I really did need to develop the parameters around it, and started getting into risk models and understanding that. And then all of a sudden, it becomes a lot more about that. So the entries to your systems, or the actual system methodology, you can start to see it's only a very small part of the piece of the puzzle. It's a very small part of what makes it successful. And that's what sometimes the common perception out there can be a little bit misleading or a little bit wrong, that it's all about your system, it's all about the entry, whereas I think that's far from the case. And all that is important, but it comes secondary to a risk model. Okay, and I think that's a really vital point to finish off on, is jumping from system to system is not going to do any good, because the same thing's going to be happening time and time again. Until you sit down and realise what your strike rate is, what your average winning trade, what your average losing trade, you create an expectancy model, you write it out in R values, you establish your maximum drawdown, and then a percentage for you as to what you don't want to go past, and then you work out exactly what you should be risking per trade. Once you completely understand all these sort of things, that's the powerful, amazing information, and it completely sets you off in a different mindset. And all of a sudden you'll be trading and seeing things completely different, and all of a sudden your systems will start working for you. That's why risk modeling is so important, and you need to look at that and focus on that over the top of the actual system. So hopefully that makes sense. We're going to elaborate on that in a couple of weeks. We'll speak to you guys soon.